Welcome to Swing Trade Pro 2.0, the 5-step swing trading blueprint. I am Frank Ochoa, president and founder of Pivot Boss and author of the book Secrets of a Pivot Boss. In this section, we are going to discuss step 5, documentation. And while documentation isn't as sexy as some of these other topics that we've discussed in Swing Trade Pro 2.0, like trade sequences and our strategy toolkit, this is a very, very important step in the process of a developing trader and experienced traders, because documentation allows you to review past performance so that you can improve from that performance. You can improve upon those weaknesses or reveal strengths that you can then build upon. So again, documentation isn't as sexy as some of these other sections that we've covered here in Swing Trade Pro 2.0, but it is a very, very important section that I hope that each and every one of you utilize in your trading. Step 5 of our 5-step blueprint captures the importance of proper and routine documentation, including periodic review of such documentation. In order to improve as a trader, you must learn from experience, including learning from losing and winning trades alike. This process allows you to identify patterns from your performance history that may reveal strengths that you can build upon or weaknesses that you can improve upon. While documentation is often overlooked, it is a vital and necessary routine for serious traders. In this section, you'll learn how to properly document your trades, including entry and exit documentation. Remember, it is not enough to simply document the results. You must also periodically review your documentation and results in order to reveal tendencies that may be helping or hindering your trading. So with regards to entry documentation, we will be talking about 3 different sections. Entry documentation will you'll basically learn how to document a trade at the entry. Exit documentation, where you'll learn how to document a trade after the final exit. And trade log and review. You'll learn what to include in a trade log and trade journal, and also learn about the importance of periodic performance review. So let's go ahead and get started with entry documentation. In this section, you'll learn how to properly document your trades at the outset of a position, at the entry. An efficient approach to entry documentation is to take a screenshot of the chart, followed by annotating the chart itself with notes that include the following information. Number 1, trade allocation. Number 2, setup. Number 3, strategy. Number 4, entry allocation. Number 5, targets. Number 6, entry price. And number 7, trade notes. Now, one thing I want to say right at the outset is you have to create a routine that works for you. I am going to give you some of the ideas for what to do on your end, but ultimately, if you make your documentation too involved or it takes too long for you to do it, if it becomes a burden, you will not do it. So do what you need to do in order to successfully document your trades day in and day out, and so that you can review those trades as well. Again, the importance of documentation is significant, because you can glean so much information from past trades that will help you in the future. So number 1, we're noting trade allocation. So number 1, what is your trade allocation that you have chosen for that trade? Is it an aggressive allocation, a moderate, a conservative? Note that trade allocation. Number 2, setup. Note the setup that you have chosen to trade. Is it a rejection day trade sequence? Is it a stop run day trade sequence? Is it accumulation sequence? What is that setup? Note it and document it so that you know and can categorize it for later. Strategy. Note the strategy that you will be executing from the toolkit. So again, are you using a call spread? Are you using some sort of credit spread? Are you using an in-the-money call, out-of-the-money call? What are you doing? What is the strategy that you are executing for this trade? Document that down. Entry allocation. Note the execution technique that you will be using to enter and manage the trade. So are you using the 1x2 entry technique? Are you entering 100% entry? Maybe you're doing the 1x3 entry technique. Those are very, very important. And again, how are you going to manage the trade? Are you going to get all out of the trade in one go? Are you going to scale out in halves or thirds? Which way are you going to manage the trade? Again, note that down on the chart. Targets, note the profit targets that you have forecasted for the trade. Again, it's good to understand ahead of time where you believe price will likely go, and then you note that down for your reference for later. Entry price, note the entry price for the trade, including taking a screenshot of the option chain if you need be, or whatever other materials you need to capture. Trade notes. Number 7, just jot down any pertinent notes for the trade, including current or foreseen market conditions, any confluent zones or general trade thoughts, etc. And again, the easiest way to do all of this is to take a screenshot of that chart. As soon as you enter a trade, take a screenshot, and from there start jotting down this information. Here's a trade I took in Amazon. This one again has been trending up, or had been trending up significantly. It's been going to the moon in terms of price. And again, an efficient approach to entry documentation is to take a screenshot of the chart followed by annotating the chart with the notes that include the following information. Here are the 6 various things we discussed plus the 7, which is notes. And in this case, again, we had been trending higher in Amazon, in uptrending market. We were retesting prior highs here, the previous month's highs, into an LVN, and formed a rejection day. Not a super strong rejection day, but again, a rejection day nonetheless. In this case, the trade allocation that I used was 1.5% of allowable trade allocation. Here, the setup was a rejection day. The strategy I chose to use this time was a put credit spread. So I sold 5 1800 and 1797 half puts. So basically, I sold the 1800 put. And remember, by selling that put, it's basically a true or false. Is it going to close above 1800 or below 1800 at expiration? And so it's a simple bet. I was betting that price would close above 1800. And not only that, I was also forecasting targets up to the recent high of 1860. So as soon as that thing were to pop up there, that's a great time to take that off the table. Now, in this case, the entry allocation was 100%. I got in 100% of the trade right here, right where we're at. This isn't the end of the day, but as a matter of fact, this is right when I entered the trade. It was about 1798, and I entered a slightly out of the money put credit spread. So I sold the 1800 put when price was at about 1798, so it was a couple bucks out of the money. I also bought the 1797 half put for protection. So in case price was to drop through that area, I was covered. Okay, and now in terms of targets, again, I'm looking for price to rally toward 1860 over the next 3 to 5 days. And secondly, I'm looking for price to close simply above 1800 by the expiration, which was 727. This was 723, so basically 4 days or 3 or 4 days to expiration, and I needed price to close above that zone. The entry price was a credit of $1.27, so I basically took $1.27 credit on that one for a shot at returning to highs. So I take $1.27 credit times 5 contracts, and that gives you the total potential gain on this trade. Now the notes for this trade: strong uptrend with a rejection day at the CLVN, a rejection at the 821 PIMA trigger zone. So there's the PIMA, right? That's the 8 period, that's the 21 period. In an uptrending market, that's the best area to look for rejections and buy for a continuation higher within the uptrend. Over here, I'm expecting price to close above 1800 by 727, and I'm expecting good earnings and positive reaction to earnings with an upside target at 1860. So earnings was coming up in a couple of days. So that's the entry. And again, the easiest way, take a screenshot right after you enter the trade, or perhaps at the end of the day if things are very crazy. Take a screenshot, note where you enter the trade, what were the entries, what's the strategy, trade allocation, all those various things. Jot it down and move on. And now keep this in a folder somewhere on your desktop so that you can refer back to it whenever you need to. Now let's discuss exit documentation. In this section, you will learn how to properly document your trades at the conclusion of a position. For the sake of efficiency, take a screenshot of the chart once you've completely exited the position, and then annotate the chart with notes that include the following information. Number 1, exit price. Number 2, profit and loss. Number 3, percent ROI, days in trade, max adverse excursion, max favorable excursion, and any trade notes. Again, keep in mind that you only want to do what you're willing to do. If this sounds like it's too much for you to jot down and you're not going to do it, it's not useful to you. The reason why I added documentation to Swing Trade Pro 2.0 is because I want you to get better. I want you to learn from your past mistakes. I want you to improve upon your strengths, and I want you to basically get better. And by getting better at trading, it's normally due to seeing what you did in the past and improving upon that, whether they're strengths or weaknesses. And so again, some of these may seem daunting, like a max adverse excursion, for example, but it's not very difficult to calculate that. So number 1, exit price. Document the exit price for the trade, including all scales. Number 2, document the P&L for the trade. What's the profit or loss for the trade? Document the gain or loss as a percentage of initial investment. That's your ROI. Also document the number of days in trade. I always like to see how long was I in trade for that opportunity. And max adverse excursion. Document the farthest price went against your entry price while the position was still in trade. And max favorable excursion. Document the farthest price went in your favor from the entry while the position was still in trade. And lastly, document any pertinent trade notes. So document what went well for the trade, document what could have been improved for the trade, and document any market conditions that may have positively or adversely affected the trade. Let's take a look at the Amazon example. Alright, so here we are, 4 days until earnings. Remember, I got into the trade right here. Price pops up and hits 1860 2 days later. So we got the favorable pop we were expecting. And then price pulls back almost to 1800, and that's on earnings. Or the day after earnings, price gaps up again and hits 1880, and then drops almost all the way back to 1800. So let's talk about this trade a little bit. Number 1, we want to document the exit price. I ended up buying back the put credit spread for a nickel. And so again, I basically sold the put credit spread for $1.27, and then I bought it back for a nickel. That was essentially what happened in the trade. Now, profit loss, I gained $1.22 credit. The ROI was I made 96% of that allowable trade. And then the days in trade was 5. The maximum adverse excursion was about 50 cents. I don't even think it was that much, but it was about 50 cents if at most. And the max favorable excursion was 22 points as price went right to 1880. A major move up in our favor. So again, another, if you want to add a 7 right here, would be the MAE-MFE ratio. So you can basically see that ratio, and again, that's a great ratio when you only go against you 50 cents and it goes in your favor 22 points. Again, it goes back to understanding great trade location, understanding where you want to do business, and getting in when price is at that area without hesitation, and then letting the market do what it may. So that's how this trade turned out. Now here's some notes on the trade, because it looks sunny and happy here, but it wasn't that easy. It could have been, but I allowed it to be a little bit harder than I needed to. Number 1, price hit 1860 target in 2 days. So it hit that target in 2 days, right? But I held the trade for a shot at a max profit, which is basically a close above 1800. And so remember, I sold the 1800 put, and here we are 60 plus handles away from that level, And instead of selling it off at this point for, say, a nickel, or buying it back for a nickel and being done with the trade, I said, I'll just let it expire worthless. And then I won't have to pay commission on the trade, and everything's fine. Well, the next morning, price gaps down. And then it drops all the way down to about 105, 106. It dropped all the way back. And so at this point here, while I had a $1.27 credit and it went all the way to about a nickel here, I let it come all the way back to about $1.20 something. I let it get all the way back almost. Not quite to that area, but I let it get all the way back, say to about 115 or so. I don't remember the exact number because time decay had already hit. So it was something. It wasn't all the way back, but it got all the way back. And at that time, I went from feeling like a genius to feeling exactly opposite from a genius. And so again, I held it. I said, you know what? We have earnings the next day. And Amazon is going to kill earnings. That was my belief, and that it would actually see a positive reaction to earnings. Well, they did. They made $5.07 versus 2 something estimate, and this thing gaps up and hits 1880 the next day. And again, at this point, again, it was trading somewhere between 0.01 and 0.05, and it even went negative. It even went about a negative 10 cents or something like that. It was actually a negative to get into that trade at that point because it was so far off. And again, I said, you know what? I'm going to go ahead and just let it expire worthless. And then an aggressive sell-off ensued where this thing sold off a full 70 plus handles all the way back to 1805. And again, I held it all the way back. So I made this much harder than I needed to be. I could have been out here, in and out, been done with the trade at a nickel. And instead, I held it, and this thing came all the way back. This was expiration, and I still didn't even allow it to expire. I said, you know what? I tap out, and I'm going to get out at a nickel. And I did. I put a nickel. I got out probably in the last hour of the day, just in case. And I was done. So instead of just taking it off early at the target, I held it to avoid paying commission and just be done with it and getting the full 100% credit. And that was not a great idea at that time. Sometimes it is, sometimes it's not. But I definitely allowed my heart rate to increase several times in here when it really didn't need to be the case. So again, I write that down right here. Price hit 1860 target in 2 days, but I held the trade for a shot at max profit, which is a close above 1800. I could have bought back the credit spread for a nickel 2 days into the trade. Instead, I bought back the spread for a nickel 51 minutes before expiration and had to sweat the pullback after earnings. Overall, it was a great trade, but there was some things to work on. Again, I know this trade really well because I put the notes on it, and I can go back and refer back to it. Now let's talk about trade log and review. You have your entry documentation, you have your exit documentation, which involves taking screenshots and jotting a few notes on the chart and then filing it away for later. In this section, you'll learn what to include in a proper trade log and journal, including suggestions for periodic trade and performance review. Here's what to include. Number 1, in a trade log, you can create a spreadsheet. It is important to keep a log of all trades, including any and all pertinent information as it relates to the trade. Again, I would not go over the top with creating a very detailed trade log. I've done that before. I've created incredible spreadsheets, and then those incredible spreadsheets take incredible amounts of time to continue to keep up, and then over time they just phase out and you don't use them anymore because you get busy. And so again, that's not what I want here. I want a simple trade journal, a trade log, a trade journal, all of these. Make it simple. Make it something that you can do quickly, just a few bullet points. Put it in an Evernote file, put it in a OneNote file, handwrite it down in a notebook. Do what you need to do to make it simple and some routine that you can do. In this case, for a trade log, like a spreadsheet, again, you're putting just the most important, pertinent information there. You can have all this data mining stuff you want, but again, if you're not going to do it, then it makes no use of it. You can't use it. So over here, a trade journal. It is important to keep a trade journal, either handwritten or digital or both, that will allow you to jot down notes on the market for trades, market insights, etc., which should be periodically reviewed. So again, this can be a handwritten notebook. I have handwritten notebooks from 20 years ago, my first ones that I started when I would write all of my ideas and notes and all of the various setups and all my code, all those things in these old notebooks that I still have today. I love writing in handwritten notebooks, but for the most part, I use digital now, right? We're in the digital age. I use an Evernote for my files, and Evernote is incredible. I'm able to quickly search for those files, search for my notes, search for various things, and it pops right up really quickly. It's a much better, faster way, and then it's available on all of my devices. So I have Evernote on my phone, on my tablet, on my laptop, on my desktop, wherever I need it. And again, the same thing is, if you use OneNote, it's the same type of deal. So I would encourage that you use one of these types, or at least a handwritten notebook, when it comes to trade journaling. Over here, trade review. Periodic trade review is extremely important, as this allows you to improve upon weaknesses and build upon strengths. So it's very important for you to review your trades as well. Again, you have to review on a schedule that works for you. If you're reviewing way too much and it's getting daunting or it seems like a chore, then space it out a little bit. Sometimes people want to do a daily review at the very end of the day just to see where you are, what was entered, what was not. And then you might want to do a more broader weekly review where you look at what happened over the course of the week or the course of a month. Or maybe you review everything off of a milestone, like, for example, every 100 trades you're reviewing those 100 trades to see if you can reveal any patterns or tendencies about your trading. Again, you want to do something that will fit within the confines of what you're willing to do on a routine basis. Down here, journal review. Periodically review your trade journal as well, as it allows you to review your notes on prior market conditions, analysis, forecasts, and to measure how these eventually turned out in the future. Again, a weekly, monthly, or some sort of specific review is very important. For example, specific review is something I do more often. So, for example, if we've been building out in these markets like this, and now we're way up here, and then we did this, then sometimes I'll go back to that point in time and say, what was I saying? What was I thinking? What did I think might happen at that point? And then it gives me an idea of what I was thinking in the past. Or if this happens here, what was I thinking here? And how did I believe market was going to move in the future? So a specific review. Or, if an FOMC day is coming up soon, what happened in the past, I'll go back and review. So there's specific review that you can do. That's mostly what I do, but there's also the time-based review every month or every week. But again, I usually do a specific review, but everybody's different. So let's take a look here at what I usually do after a trade. And again, you can add a little bit more, add a little less. Not every trade has all of this information, but sometimes, most of the times they do. A quick log. This is a quick trade log. What's the ticker? I traded Amazon. How much did I make on that trade? It was $610. 5 contracts at 122, I believe. Right here, rejection day, CLVN. That's the setup. It was a rejection day at a CLVN. What's the strategy I used? Slightly out of the money, put credit spread. Right? Trade allocation was 1.5%. Entry allocation was 100% of entry. The entry date was here. The exit execution was all out. The exit date was the 27th, and the days in trade was 5. Just very, very simple trade log to get you a quick understanding. Now, I used to do those trade logs where you type in the what was your entry price, what's the profit factor for the ES versus the crude oil, and the spreadsheet would just automatically know what that is and calculate your contracts by the amount that you traded and how much you made, and then also throw in for example commissions and all that stuff, And again, those big old spreadsheets can get daunting to continue to keep up. Something like this is much faster. What's your P&L? What's your strategy? What did you think was going to happen? You can do this much quicker. And again, when that's the case, you're likely going to stick with it more often. Now, here's a trade recap. Again, Amazon developed a rejection day at a critical market structure CLVN of 1780. The rejection also coincided with the 821 Pima trigger zone. The rejection of this level suggested a rally to previous market structure resistance at about 1860. Earnings on Friday, 7/27, and expected to beat and for price to move higher. That was the idea. The trade went in my favor immediately, reaching the 1860 target in 2 days. So, reinforcing the good. I executed a precision entry after morning rejection, believing that bullish absorption was already occurring off the 1780s. So in the morning, after the price sold off significantly, it had only barely started to bounce, but we were seeing absorption at 1780s, which was right at the CLVN. I didn't make my trade till much later in the 1798s, only because I wanted to be sure that that was occurring. But again, we could have gotten in a little earlier. I held steadfast to my belief that price would close above 1800 by the end of the week, even under extreme conditions after earnings were released, including, this is what you can't see in that chart, price initially dropped to as low as 1806.96 after earnings were released, and my heart rate was clocked at 71 beats per minute during this time. Again, I have a heart rate monitor on, a Fitbit, and anytime things are getting really crazy in the market, or if my trades are going far against me, I have a habit of looking at my heart rate to see what it is. Typically speaking, my resting heart rate might be somewhere around 65, maybe the low 60s. It had only raised a little bit during that time. Now here, price gapped up the next day after earnings to 1880, but then dropped all the way to 1806.53 at around noon on expiration day, before settling above 1800 for the week. So again, extreme conditions here where price is up as high as 1880 and then dropping 70 plus handles very quickly and approaching that 1800 put that I sold. Now, need to improve. I had at least 2 different chances to buy back my put spread for a nickel, but instead decided to hold. So improve. Look to take quick profits on a credit spread if a nickel can be had early in the trade. This will give you quick profits and allow you to begin putting new money to work on another opportunity. So I could have been done with this trade 2 days in and been using that mental capital and physical capital for other trades. Instead, I held for an additional 3 days and had a whole roller coaster with it. So here's my take action. This is what I can improve upon. Now, how do I take action? As soon as the credit spread is executed, to open the position, execute in order to close the position for a nickel. So right away, put in your target. This will help semi-automate the process and take the money when it is there for the taking. So again, that is not only identifying what to improve on, but then jotting down an action item so that you can take real steps to correcting that behavior. And so again, a great trade right out of the bat. I let it get kind of squirrely, and that tells me, hey, some of the things that were good, in the face of significant pressure, I was still cool as a cucumber, but at the same time, I could have taken action and will take action to correct that in the future. So this is what that type of trade log looks like. You have the log here, you have the journal here, the trade recap. You can even squeeze in a little screenshot so you kind of remember what happened of that chart right there. And again, this is a quick way for you to put this together. Now I slapped this together here onto a presentation slide, but usually this would be in my Evernote, where this is at the top end of the trade and then I have bullet points underneath it, perhaps a screenshot, the entry and the exit screenshot that can go with it as well. And now that's one Evernote file under my trading journal. So again, this is a way that you can also build something like this to remember these trades, understand what you did well, understand what you can improve on, and then take action items to improve upon those weaknesses in the future. And this is the process for getting better. Again, when you look at the best performers in the world, like elite athletes, for example, the Tom Brady's of the world, they don't win all those championships because they don't study their film. They study every single throw. They study every single handoff. They study every single coverage every single time to get better. And this is the same exact way. You are trading in a market full of incredible professionals that are much more adept at doing this than we are. They have much more money involved, heavier artillery. They are much more well capitalized. So we have to be on top of our game when we are executing these ideas. And again, this is an approach to help you get better. So that will do it for step 5, documentation. Again, it is very, very important to document your trades, the entry, the exit, any pertinent notes that you may have. Mark those weaknesses, mark those strengths, improve upon those or build upon those. Again, it is this type of documentation, this type of thorough looking at your history to see how you can improve and squeeze more efficiency out of your trading. I think it's extremely important to document, but at the same time, you have to find an approach that works for you. Don't try to do every single thing I mentioned here. Do what works for you. Some things will work, some things won't. You will find your style, and when you do, you're more likely to stay with that regimen. So again, documentation is extremely important. And always remember, champions train, losers complain. Train like a champion so that you can take profits like a champion.